Welcome back to Wellpod X. I am Tony, and today we are diving deep into one of the greatest minds in investing history, Peter Lynch. If you've ever wondered how ordinary people can beat Wall Street pros, Lynch is your guy. His philosophy is refreshingly simple. Invest in what you know. Sound obvious, right? But there's so much wisdom packed into those 5 words. Today, I'll share how Peter Lynch's approach shaped my own investment strategy, how I avoid the trap of market timing, and how can his idea continue to guide my financial decisions. So let's get started. For those who might not know, Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990. Under his leadership, the fund achieved an average annual return of 29%. That's not just good, it's legendary. But what made Lynch stand out wasn't just the numbers, it was his philosophy. He believed ordinary investors could outperform the pros by using common sense and paying attention to the world around them. One of his famous quotes says it all. Know what you own and know why you own it. Simple yet incredibly powerful. Lynch wasn't about chasing complex charts or predicting market movement. He was about understanding businesses. Lynch's mantra, invest in what you know, changed the way I approach investing. The idea is straightforward. Start with what's right in front of you. Look at the products you use every day, the brands you trust, and the businesses you understand. Let me give you an example. Imagine you notice everyone around you is buying a certain brand of coffee, and you genuinely love their product. Lynch would say, that's a good place to start your research. It doesn't mean you blindly invest, but it gives you an edge because you're seeing the trend before Wall Street analyst writes about them. Lynch famously said, the best stock to buy might be the one you already own in your refrigerator. For me, this shifted my mindset. I started paying attention to the business I interact with daily, companies whose products I trust and whose business models I understand. And guess what? These often turns out to be fantastic investments because you're not relying on someone else's analysis. You're relying on your own observation. Now, let's talk about another key principle. Avoid market timing. Peter Lynch famously said, far more money has been lost by investors preparing for corrections than in correction themselves. Market timing is the idea that you can predict the perfect moment to buy or sell stocks. Lynch thought this was a waste of time. Why? Because no one can consistently predict the market. Not you, not me, not even the so-called experts. During the market correction around COVID, I made the classic mistake of trying to time the market. I sold most of my ETFs, thinking I'd buy them back at the bottom. But instead, the market rebounded faster than anyone expected. Lynch's wisdom taught me that timing the market beats timing the market every single time. The best strategy? Stay invested. Keep adding to your portfolio consistently, no matter what the headline says. To ensure I never repeat the mistake, I now stick to a more disciplined investment strategy. I set up automatic monthly contributions to my investment account. Regardless of market conditions, some of my money will be invested into the market. This removes emotion from the equation and ensures I stay consistent, rain or shine. So how do Peter Lynch's principle guide me today? I focus on business I understand. I ask myself, do I know how this company makes money? Do I believe in their long-term visions? Second, I've stopped obsessing over short-term market swings. Instead of trying to predict what the market will do next month, I focus on what I can control, staying invested, regularly contributing, and sticking to my strategy. Lastly, I look for opportunity that others might overlook. Companies that are doing great things but aren't getting much attention from analysts. As Lynch put it, the person that turns over the most rocks wins the game. Peter Lynch's lessons are timeless. Invest in what you know. Avoid market timing. Stay curious. These aren't just investment strategies. They're principles for building long-term wealth. If you take one thing away from today's video, let it be this. Investing doesn't have to be complicated. Sometimes the best opportunities are right in front of you. Thanks for watching, stay invested, and I'll see you in the next one.